Hi everyone, good morning. So let's start with CMA final, SCMA MCQs, which are very important for exam. Okay, let's start with standard costing first, and slowly we can complete at least 6 to 7 topics today, and rest of the topics we can see tomorrow. Okay. A company uses a predetermined overhead recovery rate based on missed hours. So this says that overhead is recovered is based on missed hours. Budgeted factory overhead for the year amounts to 7,20,000. So budgeted overhead is equal to 7,20,000. But the actual factory overhead incurred was 7,38,000. So AOH is equal to 7,38,000. During the year, the company absorbed in the sense which is went for a cost sheet, which is nothing but SOH. 7,14,000 of factory overhead on 1,19,000 actual missed hours. They said actual missed hours. What is the company's budgeted level of missed hours for the year? So they says that SOH is equal to 7,14,000 based on 1,19,000 hours. So that we can find out the rate here, missed hour rate. So 7,14,000 divided by 1,19,000. 6. Sir, for BOH as well as SOH, we are going to use the same rate of 6. Now they are asking budgeted level of missed hours. It means for this one, it has to be 7,20,000 divided by 6. That has to be budget hours. So 7,20,000 divided by 6, which is 1,20,000. So 1,20,000 has to be our answer. So remember that for both budgeted overhead as well as actual overhead, recovery rate will be the same. They given that how much we absorbed to the cost sheet, which is 7,14,000 based on actual hours, because SOH is always based on actuals, right? So based on actuals, it was 6 rupees. The same 6 rupees will be applicable for BOH also. So based on that, they're asking us how many budget hours we are budgeted for. Okay. Next, based on the given data, what is the amount of overhead under absorption, overabsorbed or underabsorbed? Okay. The overabsorbed, underabsorbed in the sense it is absorbed overhead is nothing but SOH. Actual overhead we are supposed to compare with. So at the beginning we are going to prepare a budget. At the end, for actual production, we create a standard which is nothing but absorbed overhead. The difference between SOH and AOH is nothing but under absorption or over absorption of overheads. So let us compare with that. They given that budgeted overhead is 4,93,000, budgeted missed hours is 10,960. Then we can find out budget rate, right? So budget rate is equal to 4,93,200 divided by 10,960, which is 4,93,200 divided by 10,960, which is 45 rupees. Sir, what is SOH? SOH is always for actual output. So where 45 into 10,493, that has to be SOH, and AOH is 5,14,157, which is already given. That implies 45 into 10,493, which is 4,72,185. So it has to be under absorbed, because actual is 5,14,000 and SOH is 4,72,185 under absorbed, and the difference between that will be 5,14,157 is minus 41,972. So it has to be D. Next, the information relating to direct material cost of a company is as under. Standard price per unit is given, actual quantity, that is nothing but AQ is given, SP is given, and standard quantity for actual production, which is nothing but SQ. Material price variance on purchase is favorable 240. Now what is actual price? So we know that what is price variance? Actual quantity into standard rate minus actual rate is equal to 240. That implies 1600 into standard rate. Standard rate is 3.6. 3.6 minus actual rate we are supposed to find out from 240. So it has to be 240 divided by 1600. Difference is 0.15, and they said it is favorable. It means actual cost is lower. So minus 3.6, which is 3.45. So 3.45 has to be our answer. So the difference is 240 by 1600, 0.15, and as it is a favorable price variance, actual price has to be lower, then only it will be a favorable. So 3.6 minus 0.15, it will be 3.45. Okay, next, the company uses standard absorption costing. The following information was recorded by the company for October. Sir, they have given budgets information as well as actuals information. They're asking us sales price variance, sir. For sales, under sales variances, standard quantity is nothing but budgeted quantity only. Price variance they're asking. So what is price variance? Actual quantity into actual price minus standard price. So which is 8,200 into actual quantity. Actual price is 31 minus standard price is 26. So which is 5 into 8,200. 41,000 favorable. 41,000 favorable. Okay, next. A company operates a standard absorption costing system. The standard absorption costing system. It means they're not following ABC system. Absorption costing system they're going to follow. Absorbed overhead is nothing but standard overhead. The budgeted fixed production overhead of a company in the last year was 3,30,000. So this says that BQ, the budgeted fixed production overhead of a company, so BOH is equal to 3,30,000 budgeted overhead, and the budgeted output was 2,20,000. At the end of the company's financial year, the total fixed overhead absorbed debited to the fixed production overhead account was 2,60,000. So AOH is equal to 2,60,000. That is an actual one. And the actual output is 2 lakhs units only. What is under absorption or over absorption? So we are supposed to find out SOH so that you can find out whether it is under absorption or over absorption. The difference between standard cost and actual cost is under absorption or over absorption. Now, sir, SOH is nothing but budgeted overhead per actual output. If it is, what is here? What is budgeted rate then? It has to be 1.5. Then it has to be for actual output of 2 lakhs. We are supposed to apply 1.5 into 2 lakhs, which ends to 3 lakhs. Sir, we incurred 2,60,000, but we absorbed 3 lakhs. To the P&L account, we have taken 2,60,000, but to the cost sheet, we have taken 3 lakhs. We have taken over absorption of 40,000. So it is A should be your answer. Okay, next. A company has over absorbed fixed production overhead of 6,000. Sir, over absorbed in the sense SOH is greater, sir. So SOH minus AOH is equal to 6,000. That's what they say. Over absorbed in the sense the amount what I have taken to the P&L account, the amount what I have taken to the cost sheet, which is nothing but 6,000. The fixed overhead, sir, the fixed production overhead absorption rate is 8. So SR is nothing but 8. Okay. And it is based on normal level of activity of 5,000 units. So that is for normal, we never bother about it. Actual output is 4500. So SOH has to be for actual output always. So 4500 into 8 minus what will be the actual fixed overhead they are saying. So VAOH they are finding, they are asking us, so 6000. So that's nothing but 4500, sorry, 4500 into 8, 36,000 minus 6000 has to be 30,000. So 30,000 has to be AOH. That's what they're asking. Okay, next. Most of the people are asking to share PDF, sir. I will share this PDF with answers, with the gist answers I'm writing, right? I'm going to share that one, as well as I'm going to share without answers also. Both the documents we are going to share in Shikara Telegram group. Okay, you can download from that and practice there. Okay, next. If the capacity usage ratio of a production department is 90 and the activity ratio is 99, then what is efficiency ratio? Sir, activity ratio is equal to capacity ratio into efficiency ratio. That is nothing but efficiency ratio is equal to 99% divided by 90%, which will end up to 99 divided by 90%, 110%. Clear? Next. A chemical is manufactured by combining two standard items of input A. Standard price is 60 rupees and for A, and for B it was 45 rupees per kg, and they are mixing in the ratio of 60:40, and 10% of input will be the lost during the process. Okay. If during the month 1200 kgs of chemical were produced and actual cost is they are given as 69,000, what is the material cost variance? Sir, actual cost they have given. To find out cost variance, we have to find out the standard cost. Now, as per so let's find out the standard cost. So they says that whatever the input we give, 10% will be the loss what we are going to get. It means whatever the input we give, there will be a loss of 10%, and then we are going to get an output. The output is nothing but 90%, sir. Sir, input as per standard, input should be always for actual output, right? So actual output is nothing but 1200. If this is 1200, for 90 if it is 1200, then for 100 how much it is? So it has to be 1200 divided by 90 into 100, which is equal to 1333.33, sir. Out of 133.33, A is 60%, B is 40%. This has to be 60% and this has to be 40%. So what is 60% of that? 60% of that is 500. Sorry, 800. 3% of that is 800 into 40% is 533.33. Now, sir, what is standard cost, sir? It has to be 800 into 60, 533.33 into 45. So, combinedly, it is 72,000. 72,000 is standard cost and actual cost is 69,000. So 72,000 minus 69,000, which leads to 3,000 favorable. Sir, it is actually 69,600, sir. There is a printing mistake here. It is actually 69,600. Got it right? If it is 69,600, then it has to be 2,400. There is a slight printing mistake. You can check with that. Okay, next. A company absorb overheads on machineries. In a period, actual machineries were 17,285. Actual overhead were 4,96,500. What? And there was an under absorption of 12,250. Sir, under absorption is always SOH minus AOH is equal to minus 12,250, 520, sir, because we under absorbed. Under absorbed in the sense we have taken less in cost sheet. This is the one which we have taken cost sheet, and AOH is greater, so it has to be minus. What was the budgeted overhead absorption rate per missionar? They're asking us what is the rate per missionar. Okay, the company absorbed overheads on missionar in a particular period. Actual missionars were 17,285. Okay, and actual overhead is, so this was 4,96,500. Then what should be the SOH, sir? SOH has to be equal to minus, this is minus 5,250. That implies SOH is equal to how much? 4,96,500 minus 12,500, which is 4,84,000. The SOH is always for actual, right? So actuals ours is how much? So 17,285. So that divided by 17,285, which leads you 28. Clear? So they says that standard rate is always equal to 4,84,000 divided by 17,285, because SOH is always for actual production. And actually this is absolute nonsense, sir, anyhow, because it is not based on actual missionars. It is always based on actual hours only, or actual output only. But I don't know, in CMA some MCQs they are giving like this only, it's based on actual missionars, which is absolutely wrong, sir, because SOH is always for budgeted production for actual output, not for actual missionars. That will be a definitely absolutely mistake, but we are supposed to follow the same thing, because we have observed many times that they're giving similar questions, similar MCQs, and answers also they're framing based on that only. But definitely, sir, we should not take based on actual missionars. It is always based on actual output. There is a lot of difference between actual missionars and actual output. Okay, next. Yes, sir. Now, XYZ Limited is a manufacturing company involved in the production of automobiles. Information from the last budget is given. Actual production is given. Budgeted production, it might be 2,50,000, sir. It's a printing mistake, 2,50,000. Actual fixed overhead and budgeted fixed overhead is given, and they're asking us volume variance as well as expenditure variance. So first, let's talk about expenditure variance. Just this difference between BOH and AOH. Expenditure is nothing but BOH minus AOH. So these minus these, which is an adverse 2 crore 60 lakhs. So this is the answer. And next, volume variance, sir. Sir, volume variance, there are two options there here. What it write out of these two? Volume variance is having 5 crore favorable, 5 crore adverse. We don't need to calculate that. First, you see, I told them to produce 2,50,000 units, but they produced 2,75,000 units. As they're producing more than expected, then volume variance has to be favorable. Volume variance has to be favorable, so 5 crore has to be the answer. You don't need to calculate, sir. Here, even with the given information, we can easily find out volume variance, but in MCQs, you have to save some time. So the difference between those two is nothing but expenditure variance with the direct information. So there are two options available. These are the two options we are available with. Clear? And volume variance, if you see, that is favorable, because I told them to produce 2,50,000, but they produced 2,75,000. They produce extra units, so the volume has to be favorable. Clear? Let us say, if you have to find out volume variance, then how should we find? Volume variance is nothing but SOH minus BOH, sir. SOH minus BOH, and BOH is already given as 50 CR. Then what should be SOH? SOH is always per actual production, budgeted rate per actual production. First, let's find out budget rate. What is BR? 50 CR divided by budgeted volume of 2,50,000. 2,50,000. Got it right? Which leads to, so 25 to the 2,000 rupees. So 2,000 into SOH is equal to 2,000 into 2,75,000, sir, because SOH is always for actual production. So which is 2,000 into 2,75,000. where it is 55 CR. So 55 CR. So SOH minus BOH, 55 CR minus 50 CR, which is 5 CR favorable, which is equal to 5 CR. That is how we can calculate it. But for MCQs, we have to save some time. So just we can identify whether it is favorable or adverse is fine. Because with the direct information, we can say that the difference between these two is expenditure variance BOH minus AOH, and it's an adverse there. As it is an adverse, there are two options. Clear? And based on that, we have to fix it. Next, the information related to direct material cost of a company is as follows. Okay, a standard price is given, standard quantity is given, standard quantity allowed for actual production, which is nothing but SQ. Material price variance is given, and what is the actual price? So similar questions we solved it, sir, already. Yeah, this is the same question. There is nothing difference in that. Just it is 480 divided by actual output, sir. 480 divided by actual quantity, because price variance is always calculated based on actual quantity. Got it right? So 480 divided by 1600. So 0.3 has to be 0.3 has to be difference, and it is favorable, sir. As it is a favorable, actual has to be lower than standard, so that 7.2 minus 0.3. So 7.2 minus 0.3, which leads to 6.9. So 7.2 minus 480 divided by 1600, which is 6.9. Okay. Next. So there says that they're using activity based costing to allocate overheads. The budgeted cost or expected for the supervisor cost pool as given. Okay, budgeted units is given, number of employees is given, budgeted cost is given, actual units, actual number of employees, actual cost is also given. So what was the total variance of the setup? So it's very simple. Total variance is nothing but standard cost minus actual cost. Actual cost is given as 8085. What should be the standard cost? So standard cost should be always for actual output. Now, what is based on budgeted cost per unit? Budgeted cost per unit is nothing but 7500 divided by 5000. 7500 is the unit cost per 5000, which is 1.5. Now, what is standard cost is for actual output, which is actual output is 5500. So 5500 into 1.5, that has to be the standard cost and actual cost difference. That is, so 5500 into 1.5, which leads to 8250 minus 8085, which is 165 favorable. 165 favorable. Sir, here number of employees is irrelevant, sir, as because they're asking us total variance, that is nothing but standard cost minus actual cost. Now, what is actual cost? They already given. Standard cost is nothing but always for actual output. So actual output is 5500. What is budgeted cost per unit, which is 1.5. So standard cost for actual output is nothing but 5500 into 1.5, and actual cost is 8085. Difference between that has to be the cost variance. Okay, next. The preparation and use of standard cost, their comparison with actual cost, and the measurement and analysis of variance to originating cost is defined as. That's what standard cost and comparisons and with actuals, that is nothing but standard costing, right? That is the definition of standard costing. Clear? What do we do at the beginning of the period? We are going to prepare standard cost for every unit. For every unit, the same standard cost we are going to apply for budgeted output, and we are going to get budgets. At the end of the period, we are going to get actuals. These two cannot be compared. Why these two cannot be compared? Because this is for budgeted volume, this is for actual volume. When volumes are different, we cannot compare them. So at the end of the period, we are going to recreate the budget for actual output. That we compare with actuals, and we are going to find out the variance analysis, reasons why there is difference between that, and we are going to find out performance of various departments, which is nothing but a standard costing definition. So we can go for standard costing. Next, sir. The following figures are extracted from the books of a company. Budgeted overhead is given, budget hours is given, Actual overhead is given, actual hours is given. Out of budgeted overhead, fixed how much, variable how much is also given. Fine, sir. Variable overhead cost variance and fixed overhead cost variance will be they're given. Let's talk about fixed overhead because always fixed overhead is very simple. So we are going to take BR or SR, SOH, and the given AH, AOH. Then we are supposed to find out SH, SH, BR or SR, BOH, sorry, SOH. And this has to be BOH. Okay. Sir, for variable overheads, they given that fixed is budgeted fixed is 6,000, actual fixed is 6,100. What it, sir? Okay. Now, what they're asking variable overhead cost variance and fixed overhead cost variance. It means the difference between these two we have to find out. Now, budget hours is given as 2,000. Now, budget rate is nothing but 3 rupees. So, this also has to be 3. 6,000 by 2,000 has to be 3. So, standard rate or budget rate also has to be 3. So, to take difference between these two, I wanted to find out standard hours. Standard hours. They have not given. That's what we discussed, sir. Standard hours is always for actual output. But whenever such information is not given, then we are taking based on actual hours only, absolute nonsense, but still they are using the same, sir. Actual hours 2,100 into 3, which is 6,300. 6,300 minus 6,100, which is nothing but 200 favorable. So that is the answer they have given, sir. But it is an absolute nonsense because actual hours and standard hours will not be the same. But actual hours and standard hours is always per actual output. That is okay. But whenever such output is not given, they are considering actual hours is equal to standard hours, sir. And based on that only they are giving answers. So multiple times they did the same thing in CMA MCQs, so that we have to follow the same, sir. But output, if output is given, then we can use that output and we can follow. Clear? So 200 favorable. There are two options for 200 favorable. Okay. Next, variable overhead cost variance they are given, sir. Next, similarly, variable overhead also same. What is standard hours? Not given. So we have to take actual hours only. And cost variance is nothing but then what is standard rate? Standard rate is nothing but budgeted rate only, which is 4,000 divided by 2,000. 4,000 by 2,000, which is nothing but 2. And actual hours is 2,100. And actual rate, or anyhow, actual overhead is 4,300 they given. Standard cost is, and we can find out, standard cost is 2,100 into 2, which is 4,200. Compare that one with actual cost of 4,300, that will be 100 adverse. So C has to be the answer. Though it is wrong, we have to follow the same thing, sir. Next. In a factory where standard costing system is followed, the production department consumed 1100 kgs of material at a rate of 8 per kg of X, resulting in a material price variance of 2,200. See here. In a factory where the standard costing system is used, the production department consumed, that's nothing but AQ. AQ is equal to 1100 at a rate of 8 rupees. So that's nothing but AR. That's okay. And the resulting material price variance, that is nothing but actual quantity into standard price minus actual price, is end up with 2,200 favorable. So 2,200. So we're having standard actual price is having as well as actual quantity is having, so that we can find out standard rate here. So SP minus 8 is equal to 2,200 divided by AQ is 1100, which is 2. So that implies SP is equal to 10. That is one thing we can find out. And material usage variance is 1,000 adverse. What is usage variance, sir? Standard price into standard quantity minus actual quantity is given as minus 1,000 adverse, sir. Then what is the standard material cost of actual production? That's nothing but standard cost they are given. So that we wanted to find out standard quantity here. If they're asking standard cost, I want SP into SQ. SP is there 10. SQ I can find out from this one, which is SQ minus 1100 is equal to minus 1000 divided by 10, which implies SQ is equal to 1000. So therefore standard cost is equal to SQ 1000 into standard price is 10, which is nothing but 10,000. So 10,000 should be the answer. Next. Okay. AB Limited uses standard costing system. Okay. The following information pertains to direct labor for production X for the month of March 2019 is given. Oh, values are missing. Okay. So what they're asking us to find out actual hours work they're asking, and labor efficiency variance is given. So let us say they have not, values are missing here. Let us say they have given efficiency variance. So what is efficiency variance, sir? Standard rate into standard hours minus actual hours. So this is given in question. Understood, right? This is given in question, and they're asked standard rate per hour. This also given, and actual rate per hour is not required for us. Standard hours allowed for actual production, SH is also given, and they're asking AH. Anyhow, if the values are given also, just application of formula only. So efficiency variance is given, standard rate and AH is given. So sorry, SH is given, AH we are supposed to find it out. Okay. Then so the higher actual hours worked, if higher the actual hours worked, if AH is higher, then the higher the capacity usage, the lower capacity usage ratio, higher capacity usage ratio, lower capacity utilization ratio, higher capacity utilization ratio. Sir, actually capacity usage is AH by BH. Out of budget hours, how many hours we utilized is called as capacity usage ratio. What is capacity utilization ratio? Capacity utilization ratio is AH by maximum possible hours. Max possible hours. Sir, if AH is higher, then what about usage variance and utilization ratio? Both will be higher, obviously. If numerator is higher, obviously the ratio also will become higher. So the both answers correct only. B and D both are correct only. But specifically we are giving this one because it is one of the past examination question of CMA, and they are given this as an answer, but which is absolutely mistake. Anyhow, B is also correct because in both the cases AH is in numerator only. What it, both the ratios will get higher if there is higher actual hours worked. Clear? Okay. See problem number 18. Okay. Next one. A manufacturing company uses two types of materials, X and Y, for a manufacture of a standard product. The following information is given below. So to manufacture a standard product, they have given two materials, X and Y. Standard mix is given, actual mix is given. Okay. So metal X, Y and all given. Now they're asking direct material mix variance, sir. What is mix variance? Standard price into RSQ minus AQ. That has to be the mix variance. Sir, what is RSQ? RSQ is nothing but total actual quantity in standard mix. So what is RSQ of A and B then? A and B is nothing but 200 But that is what actual quantity what they used in the ratio of 120:80, which is nothing but 3:2. That is what RSQ. So it's nothing but, so 5, 4, 40, 120 it is, as well as, so 80. By 5, 40 into 3. Okay, standard mix also. Okay, standard mix also 200, actual mix also, sorry, yield, standard yield total is 200, here also 200, then it has to be 120 and 80 anyhow. I might have observed earlier itself, otherwise you might have written quickly by seeing here itself. So in examination also quickly you have to see here. Sir, what is RSQ? RSQ in the sense total actual quantity in standard mix. Total actual quantity in standard mix. So actual mix and actual standard mix both are same. Then the mixage has to be same 120 and 80. But actually they used 112 and 88. Then what is SP? So for A, sir, for A, SP is 5. 5 into RSQ is 120 minus 112. And for B, SP is 10. 10 into 80 minus 88. So this has to be the answer. So 120 minus 112 into 5, 40 favorable. Okay, next. Okay, anyhow 80, 88, right? So 80 adverse, net impact is 40 adverse. So 40 adverse has to be your answer. Here. Okay, next. A factory operates at a standard cost system where 2000 kgs of raw material at a rate of 12 per kg were used for a product. Okay. So this says that, sir, the factory operates in a costing system where 2000 kg of raw material at a rate of 12 were used. There nothing but actual. So actual quantity is equal to 2000. Actual price is equal to 12. Okay. Resulting a price variance of 6000. Sir, price variance is what? Actual quantity into standard price minus actual price is equal to 6000 favorable. And usage variance, what will be the standard material cost? Same question we solved it, sir, earlier. So previously, okay, one of the question we can quickly solve this one. So here from this we can find out. So this one, these are same question, nothing difference. What it right? So actuals given, and we are finding out standard quantity. So we can, I think you can do it. It is same, just numbers are changing. You can do it. Next, see problem number 20. Okay. DM is a denim brand specializing in a manufacturing and sales of hand stitching jeans, trousers. DM manufactured and sold. So manufactured and sold, that's nothing but actual quantity. Actual quantity is equal to 10,000 pairs. Okay. Information relating to the direct labor cost and production time is given below. Actual hours per unit is, they have taken 65 per unit. Then what has to be actual hours? 10,000 into 0.65, which is nothing but 6,500. Okay. And standard hours per unit. So SH is nothing but actual production only. For actual production, as per standard, it has to be 6,000 hours. Okay. Then during a period 800 hours for idle time was incurred. Then this is actual hours paid. And what has to be actual hours worked? 6,500 minus 800, which leads to 5,700. Okay. In order to motivate and retain experienced workers, DM has devised a policy of paying workers of fully. Okay. Even there is an idle time, they paid it for total 6,500 hours to retain them. Okay, that's what they said. Then the idle time variance, first idle time variance, that's nothing but idle time is 300. So this has to be 300 into standard rate. Standard rate is always standard rate per hour 100, because idle time is idle time into standard rate. So which ends with 800, right? Idle time is 800, which is 80,000, And remember, sir, these two are absolutely mistake, because, or anyhow, idle time variance you no need to calculate, because every case they are given as 80,000. Idle time variance never be a favorable. Then definitely 80,000 adverse. We no need to do it also, sir, because you have to save some time. Just look into idle time variance. Every answer is same. Adverse has to become. So we no need to calculate idle time variance. But labor efficiency variance, we are supposed to find it out. So during calculation of efficiency variance, I am supposed to use actual hours worked, not actual hours paid. Efficiency in the sense speed of the work. When we are measuring speed of the work, we have to take how much actual hours worked by the labor, not actual hours paid, because we are paying for 6,500 hours. Due to lack of work, he sit idly for 800 hours. We cannot take that idle hours and consider the efficiency of a labor, so that actual hours worked only we have to take it. So 5,700 he worked, and we have given a time of 6,000. So we have given a time of 6,000, but he worked with 5,700. So it has to be favorable, sir. So you never do this sum, directly go for this, because we know that A and B has to be the option, so which is adverse. And here 30,000 adverse and 30,000 favorable, irrespective of the valuations. 6,000 is the time what we have given, 5,700 is the time what they have taken. So he has did somewhat speed, so that it has to be the favorable, so that go for B. The numbers are not required, so just if you use some knowledge, what is the meaning of idle time variance and what is the meaning of efficiency variance, without solving it, MCQ you can solve it. Okay, next. If actual price is 700, standard price is 400, okay, and standard quantity is 40 units and actual quantity is 50 units, then what is the price variance? So price variance is direct application of formula, which is actual quantity into standard price minus actual price, where actual quantity is 50, standard price is 400, and actual price is 700. So which is 50 into 300, which is 15,000, and negative adverse. Next, if the standard price is 50, okay, SP is equal to 50, price variance, that's nothing but SP minus AP into AQ is equal to 30, and this is for 50. Then 30 adverse, what will be the 30 adverse? So minus 30. Then what will be the actual price? As they have not given quantity, we believe that it is for 1 unit. So AP is equal to minus 30, that implies AP is equal to 80. 80 should be our answer, sir. Whenever actual quantity is not given, we assume that standards are given for unit. Okay. Okay. Next. The usage variance is 200 adverse. That's nothing but standard quantity minus actual quantity is equal to minus 200 into standard price, sir. And actual quantity is 500. This has given as 500. Then the standard quantity will be, and standard price is not given, sir. Then we have to take it always 1. That is the missing figure, and we have to find out standard quantity is equal to minus 200 plus 500, which is 300. So 300 has to be your answer. Next. Actual price of metal is less than standard price. Then what does it mean? So if actual price is lower, that will be a very good thing for us. So price variance will be favorable. Then an actual rate paid to a labor is greater than the standard rate. So actual rate is greater. So it is an unfavorable. It means the dash. So cost is unfavorable. We cannot say that, because cost is also depending upon standards. Variance, that's nothing but rate is the missing one. So rate variance is the thing. Cost is anyhow cannot be, because cost is not depending on only rate. It also depends upon hours also. So these two cannot be. So from these two we only have to choose it. Then it has to be unfavorable, because we are paying more. It has to be unfavorable. So B has to be the answer. Even though they have missing the rate, B can be answer. Next. If standard price of an input is 70, so SP is equal to 70, and actual price of an input is 50. Okay, actual quantity of an input is 250. actual quantity is equal to 250 and allowed standard quantity of it is 90, then what should be the usage variance? So they're asking usage, sir, standard quantity minus actual quantity into standard price, which is 90 minus 250 into standard price of 70. So 90 minus 250 into 70, which is 11,200 minus, so it has to be adverse. 11,200 adverse. Next. Which of the following statement is correct? The standard costing facilitate integration of accounts so that reconciliation between cost accounts and financial accounts can be maybe eliminated. Yes, sir. By the end of the year, after calculating the standard variances, we can find out the reconciliation between cost accounting profit as well as financial accounting actual profit. What I tried, we did reconciliations problems also, so that statement has to be correct. Next, standard costs are planned cost determined on a determined on a scientific basis. Okay, they are based upon certain assumed conditions of efficiency and other factors. Yes, at the beginning of the period, we have to fix the standards for each unit, or for 100 kgs or 1000 kgs. Likewise, we are going to fix a standard based on our planned conditions, assumed conditions. So that statement is also correct. Next, standard costing is defined as preparation and use of standard cost and their comparison with actual cost and the measurement and analysis of variances to cause and points of incidences. Yes, that is the reason why you prepare a costing. That is the definition of a standard costing, and it is correct. So all of the above. Then efficiency ratio. To find out efficiency ratio, that's nothing but speed of the work, sir. Efficiency ratio is always speed of the work. Your speed of the work is always calculated by standard hours and actual hours. Even if you forget about the formula, standard hours is nothing but the time what they have given for actual output. Time AH is nothing but time what they have taken for actual output. So if you compare with these two things, efficiency, we are going to get it. So let us say, sir, I have given 100, but they have taken 80. They have taken 80. It means that my answer has to be more than 100%. So is that 100 by 80 or 80 by 100? Which gives more than 100? Obviously 100 by 80. So standard hours divided by actual hours has to be the answer. Even though if they take 120 hours here, it means we got adverse, because I have given 100 hours, but they have taken 120 adverse. It means our answer has to be less than 100. If I have to get less than 100, still it has to be 100 by 120, which is SH by AH. So SH by AH has to be your answer. Next, standard cost and budgeted costs are interrelated but not interdependent. Sir, first let's talk about interdependent. Sir, is standard cost, standards and budgets are dependent on each other? Not required, because budgets we can prepare without standards. Standard cost, without standard cost we can prepare a budget. So they are not related. Budgets are prepared at the beginning, standards at the end only. At the beginning, without the help of standards only, we can create a budget. So they are not interdependent on each other. They individually can work, but interrelated. Yes, they both are related, sir, because both will help us to evaluate the performance of various departments, and both are the cost control techniques. Both budgeted controls as well as standard control systems, cost reduces the cost, where we can control the cost. So they are interrelated. So both are for cost control only. That is one thing, and both are interdependent in the sense, not interdependent in the sense, I cannot have standards without a budget, which is absolutely wrong. We can prepare standards without budgets. They are not interdependent on each other. They are not dependent. So A has to be the answer. Next, which of the following statement is true? If the actual cost is more than the standard, we call it as adverse variance, and if the difference is less than standard, we call it as favorable. Yeah, we know that, right? If actual cost is less than standard costing, then it is favorable. If actual cost is more, it is an adverse. Okay, that is correct. In case of sales and profit, if the standard is more than actual, it is adverse. Okay, cost variance, standard minus actual. Revenue variance is actual minus standards. Yeah, correct. Both are correct. Then, which of the following may be the cause of material price variance? So, what are the causes of material price variance? They are saying. Sir, what is metal price variance formula? Actual quantity into standard price minus actual price. These three can change the price variance. Change in quantity of purchase and uneconomical size of purchase order. Yes, this definitely. If uneconomical size of purchase order, AP changes. Got it? Okay. Now, failure to take advantage of off-season price or failure to purchase when the price is cheaper, then AP is impacting. Yes, definitely it is going to impact your price variance. Change in basic purchase price of material. So, if there is any change in basic purchase price of material, then also your variance adverses. So, AP in this is for AQ and this is for AP and this is for SP. Yes, all the three will impact our price variances. So, D has to be your answer. Next, a standard cost system consists of the following key elements. Setting standards for each of the operations. Yes, at the beginning of the period, we are going to set the standards. Next, comparing the actual performance with the standard performance. Yes, that's what we are going to do under standard costing. Analyzing and reporting variances arising from the differences between actual and standard. After evaluating the variances, we are going to analyze them and report it. Why there is a reasons between standards and actuals. Yes, D is correct. Next, variance analysis involves breakdown and analyzing the total variance to explain. So, variance analysis, they are just asking us, we can break down the total variance to explain what? How much of the variance is caused by using the resources that are different from the standards, that is the quantity variance. Yes, and the next one is rate variance. Yes, both of these will take in, right? To find out how much is the total variance, total cost variance, we should find out quantity variance as well as rate variance. That's nothing but a price variance. So, both are the reasons why there is a difference in cost variance. So, both of those. Next, direct labor efficiency variance is calculated. Efficiency variance, sir. So, it compares the difference between standard hours and actual hours. So, SH minus AH. When we are comparing efficiency, rate has to be the standard. Got it? So, A has to be the answer. 35. A company uses standard absorption costing. The following information is recorded by the company for the October. So, standard absorption costing we are using. So, absorption costing is nothing but absorbed overhead is nothing but SOH. They given budgets and actual. They given anyhow price variance only they are calculating. So, price variance is always for actual quantity into actual price minus standard price. As it is a sales, it is the difference between actuals and standards. So, actual quantity is 8,200, actual price is 31, standard price is 26. I think similar question already we solved it. So, 31 minus 26, which is 5 into 8,200, 41,000 favorable. Next, in a factory where standard costing system is followed, the production department allowed 1200 hours of standard labor hours at a rate of 16 for the actual output for the actual 1000 units of a product, AMU resulting in a labor rate variance of 15,000 favorable. The actual labor rate variance rate per hour is 14.5. How much actual labor hours worked during the period? Okay, so if you see here, the standard costing system is followed. The production department allowed in the sense what they have given 1200 hours of standard hours. That's nothing but standard hours is equal to 1200 at a rate of standard rate is equal to 16. And the actual production of 1000 units resulting in labor rate variance. Sir, what is rate variance? Standard rate minus actual rate into actual hours is equal to 15,000 favorable, they said. Understood? And they're asking us to find out how many actual hours were worked during the month. So they're asking us how many actual hours. So it is AH is the missing figure. Standard rate is 16 and actual rate is 14.5. So which is 16 minus 14.5, 1.5, 15,000 divided by 1.5, which is 10,000. Next, this is a manufacturing company using standard costing system as the following information pertaining to a normal production of 15,000 units. They are nothing but budgeted production of a product of a month of April. Okay, the standard factory overhead rate based on normal volume of 1 direct labor hour per hour for the month of April. Okay, the standard factory overhead is given as variable is 15, fixed is 18, total 23. Units actually produced during the month was 14,000. Okay, actual factory overheads incurred including 87,000 of fixed is 2,90,000. Actual direct labor hours is 14,000. What will be the variable expenditure variance? The variable expenditure will take actual hours into standard rate minus actual rate, and they're talking about only variables, sir. They're talking about only variables. What is actual hours? 14,000. What is standard rate? 15 rupees. As per standard rate is 15 rupees. And what about actual? As we're talking about variable, it has to be variable cost is 2,90,000 minus 87,000, which is 2,03,000 divided by 14,000. So which is nothing but 14,000 into 15, which is 2,10,000 minus 2,03,000, which is nothing but 7,000 favorable. So 7,000 favorable has to be our answer. Next, again they're using standard costing system. They are saying standard direct labor hour rate is given, so that's nothing but SR. Actual direct labor hour rate is given, which is nothing but AR. Rate variance is given as 15, so that's nothing but AH into SR minus AR is equal to 15,000, so which is 16 minus 14.5 into AH is equal to 15,000. Okay, and standard hours allowed for actual production is 8,000 hours. That's nothing but AH okay is already given 8,000. Actual output is 800 hours. How many direct labor hours are worked during the month of May 2023? So that's nothing but 15,000 divided by 1.5, sir, which is again 10,000. Same question earlier already we done. So that's nothing but AH is equal to 15,000 divided by 1.5, which is 10,000. Then 39. A company producing output X and Y uses standard costing. The standard overhead contains each of the product is X is 3 per unit, Y is 2.25 per unit. That is overhead, standard overhead absorption rate, sir. Now budgeted overhead is 860 and budgeted time is 3,400. It's okay. And actual output is also given. Actual time is given. Okay. Actual overhead is given. Compute overhead volume variance, sir. Compute overhead volume variance. Sir, volume variance is difference between SOH and BOH. What it, sir? Budgeted overhead is 860. So BOH is given. We are supposed to find out SOH. Sir, SOH is always for absorbed overhead per actual output. What is an actual output? 200 and 100, and the rate based on standard has to be 3 on 2.5. So SOH has to be 200 into 3 plus 100 into 2.25. So that is always absorbed overhead, sir. What do we do absorbed overhead? At the beginning of the period, we calculate a budget. At the end of the period, sorry, during the period when we are preparing a cost sheet, the same rate should be applied for actual output which is called as absorbed overhead, which is nothing but SOH. Clear? So at the beginning of the period we got 3 per unit and 2.25 per unit, and actual output is given. Then what has to be the absorbed one? So 200 into 3 plus 100 into 2.5, and they're asking us volume variance, that has to be the difference with budgeted overhead. So which is 200 into 3 m plus 100 into 2.25 m plus MRC 825 minus 860 which is 35 adverse. So 35 adverse has to be your answer. And last one of standard costing, let us see here. So again they're having a standard costing system they are following. They said standard price per unit, so SP is given, actual quantity purchased in units, so AQ they given, standard quantity allowed for actual production, which is nothing but SQ, material price variance is given, and they're asking us actual purchase price. So AQ into SP minus AP is equal to 960 favorable, sir. So 960 favorable. So that implies SP minus AP is equal to 960 divided by 3200, and SP is given as 7.2, so we can take 7.2 here. That implies AP is equal to 7.2 minus 960 divided by 320, 3200, 0.3, which is 6.9. Okay, that has to be the standard costing, sir. It will be very simple standard costing where you can get easy marks in MCQ. Standard costing has to be very simple, even for MCQs, or else 14 marks all problems what you are going to get also has to be very simple if you follow the concepts very properly. Okay. Yeah. Next, let us see one or two theory topics. Then we can go to any again problematic things. Next, sir, which of the following is not a term normally used in value analysis? Sir, value analysis will talk about what is the benefit we can get from using a product, or by purchasing a car, luxury car, what is the benefit we can get it, or else what will be the cost value. So by using a finished product, whatever the value we can get is called as usage value. Yes, they talk about it. And esteem value in the sense, by purchasing a luxurious product where they're having a very good brand value just to showcase to the other, that's what the esteem value. So most of the people will buy this high costly products not to use them but to showcase them. So that is the reason why esteem value is also we discussed, usage value is discussed, and cost value, sir. Even the manufacturers will bother about the cost value, that also we discussed. We never discussed something called as resale value under value analysis. So A is not the answer. Not a term they are saying, so sorry, A has to be the answer. Next, in value chain analysis, coordination, acquiring and assembling of resources is classified as. So first, what things we discussed in value chain? So value chain contains first resourcing, then production, then selling, then distribution, then customer service. So this is what to be contained in value chain analysis we discussed, right? Resourcing is in the sense arranging all the assets, arranging all the things which is required for manufacturing. It might be assets or it might be raw materials, labor or equipments, everything. Getting and arranging to do manufacturing is called as resourcing. Then manufacture it, then sell it, distribute it, and if there is any service required after sales to the customer, do the service. So that has to be the value chain analysis. Now what they are saying that in value chain analysis, coordination, acquiring and assembling, whenever they talk about assembling, that's nothing but a part of manufacturing. So it has to be production, sir. So it has to be a production. Assembling they have given. So production has to be the answer. Clear? Assembling is a part of production. And resourcing, no, resourcing is just arranging all those things, not manufacturing things. Value acquiring and value acquittance, that is not at all things comes under value chain analysis. Okay, next. If value added manufacturing time is 45 minutes and total manufacturing time is 80 minutes, then manufacturing cycle time, sir, total manufacturing time is 80, sir. What is total manufacturing time? Bringing raw material and doing manufacturing and placing the raw materials in warehouses, all the activities contains total manufacturing time. Out of that, the production time is called as value added. Other than bringing raw material from stores to the production and taking finished goods from factory to the warehouse, just nearer to the factory there will be warehouse. Keeping in warehouse is not a value added manufacturing time. Then what is the manufacturing time they're asking? Out of the total time, what is just a manufacturing time? That's nothing but out of 80 minutes, 65 minutes. So 65 divided by 80. So how much portion it in the sense it has to be a percentage. Based on the answers you can see it has to be a percentage. So it has to be 65 divided by 80, which is 0.8125. So out of total time, total manufacturing, value added manufacturing time is 65. What it right? They're asking manufacturing cycle time. How much you take just to manufacture the product? That's nothing but 81.25 percentage. 81.25 percentage of the total time. That should be the answer. So A. Next. Which of the following is not a primary activity of a value chain? So infrastructure, sir, inbound logistics, bringing raw materials. Inbound logistics are nothing but bringing raw material. And doing operations are nothing but converting raw materials into finished goods and day-to-day services and all. Yeah. And doing a service is also a part of value chain. But infrastructure is not a value chain, sir. Got it right? Having a proper infrastructure in a factory is not a value chain things. They never talk about that. First arranging all those things, producing, selling, distribution, services. So whenever we are resourcing, inbound logistics comes under resourcing. Is one of the example of resourcing. Bringing raw materials is called as inbound logistics. So infrastructure is not a part of value chain. Now, which of the following is not a secondary activity? Procurement of materials, human resource development and service is not a secondary, sir, definitely, because all these are primary things. Apart from this, getting labor by HR department and getting finance by the financial department and getting IT services from, invoice processing and all IT services we are going to get it. So technology development and all these are secondary things. Understood, right? But the service is the primary thing of value chain, sir. Servicing has to be a primary, so it is not a secondary thing. Next. Which of the following is important? Which of the following important pillars of a strategic cost management determine the company's comparative position in the industry in terms of performance? That's nothing but they are going to analyze where we are by comparing, by doing benchmarking, sir, we call it as. That's nothing but strategic position analysis, where we are standing. So that is the definition of standard position analysis or strategic position analysis. So that's about introduction to SCM part. Oh, and so this page is duplicated. Yeah, next. Sorry, we have some more questions. Let us see that. Now, dash is defined as real and permanent reduction. That is always cost reduction. Real and permanent reduction is a cost reduction. And if you are fixing a standard predetermined things, and if you are expecting that our cost within the limits, is called as cost control. And whenever there is chance, by looking into, by applying these Kaizen costing technologies and all, wherever there is small scope for improvement, if you improve it and reduce permanently, it is a definition of cost reduction. Unit cost, okay, that has to be, whenever there is a real and permanent reduction, that has to be a cost reduction. Whenever you say that meeting the predetermined cost, it has to be a cost control. Okay, next. Which of the following is not a support activity of value chain? So repeated question, it's not a support activity, sir, it is a primary activity. Next, which of the following is important pillars of the strategy that determines the comparative positioning? Repeated question. Which one of the following is not true of a red ocean strategy? Sir, there is two strategies for us, red ocean strategy and blue ocean strategy. So red ocean strategy is trying to, let us say, you are not producing any new kind of product. Already there is heavy competition. There you are entering into that heavy competition by a small differentiation of a product, or with reducing selling price, by acquiring some market value from the existing market. If you can get some market value from the existing market, that is called as red ocean strategy. Blue ocean strategy is nothing but you are straight away creating a new product and creating a new market. That is called as blue ocean strategy. Now, which is not a red ocean strategist technique they are saying, which is beat the competition. Yes, that is one of the things. We have to beat the competition in red ocean strategy and exploit existing demand. That's what we are not creating any new demand, but the existing, we are having an existing demand, we have to exploit that one. So that is also correct only. And make the value cost trade off. Yes, that's nothing but you should get profits by reducing the cost. You have to get profits by reducing the cost. Next, break the value cost trade off. No, this is blue ocean strategy. Understood, right? You are straight away getting a new product and you are going to break the value cost trade off. It's not about the cost, it's about the production, new kind of product. You are creating a demand. So this has to be for blue strategy, blue ocean strategy. So it is not for red ocean strategy. So D has to be answer. Next, which one of the following is true for blue ocean strategy? So bear the competition. No, there is, you don't need to bear the competition under blue ocean strategy, because right away you are coming with a new product. So there is no competitor for you. Slowly the blue ocean strategy will become red ocean strategy, red ocean thing over a period of time. But whenever it is a blue ocean, it means that you are the only one in the market who is selling that kind of product. So you don't need to bear any competition. Exploit existing demand. No, you are trying to producing a new product. You have to create new demand. Next, make the competition irrelevant. Yes, your competition is not relevant here. Obviously, your competition is not relevant. It is irrelevant for us. Next, and make the value not. It is break the value. Got it right? It has to be the break under blue ocean, red ocean strategy. It is the make the value cost strategy. Okay. Okay. Next, let us see cost of quality. So TQM, total quality management. That is the definition only. Next, type of cost under quality consists of. So there are 4 types are actually. Listen those 4 types I will explain so that many of the MCQs you can solve it. The cost of quality in the sense, if you are not making a quality product, that will leads you to spend more cost. Not making quality product leads you to cost more, because you have to do inspections, we have to do warranties, guarantees you are giving, you have to replace the product without charging any additional cost, or else you have to repair the product without taking additional cost. Clear? So that we have to know what there are 4 kind of cost of quality. One is preventive. Preventive in the sense, before happening damaged product itself, you are going to prevent it by incurring some cost, like having a new advanced technology mission and all. You incur and you make sure that there is no damaged product. That is called as preventive. Taking actions or implementing Six Sigma and all, so that you don't need to rectify the product. So even before starting of the product itself, we are going to plan somewhere. You have to plan somehow, so that you don't need to manufacture a defective product. That is called as preventive cost, sir. Next one is appraisal cost. So after manufacturing a product, before sending that product to the customer, if you identify the defect, or to identify the defect, whatever the cost you are incurring is called as appraisal cost. The example is inspection cost. Inspection cost is one of the example. Identifying the defective products is called as appraisal cost. And next one is internal failure cost. That is nothing but, sir, before transferring goods to the customer itself, by incurring this appraisal cost, if you come to know if there is any defects in products, you have to rectify that one, right? That is called as rectification cost. That is called rectification cost. Internal failure cost, but rectification cost before reaching customers. And last one is external failure cost. The external failure cost is nothing but this is also a rectification only, but after reaching customers, and this is very high cost, sir, because your reputation will get damaged, which is very high cost. Right? You transport good to a customer and they found there are some defects, and if they give it back to you, and if for doing rectification of the damaged product is called as external failure. And before reaching to the customer only, if you have identified there are some defects and if you do rectification, that is called as internal failure. And appraisal cost in the sense, before reaching the customer, if you identify any defect products, it's not this is for identification and this is for rectification. Clear? These are the four kind of cost we are going to have under cost of quality. And type of the cost, they said appraisal, internal and external, prevention. So yes, all of the above will be the type of cost control. Next, costs that are incurred to find out a manufactured product which does not meet specifications. Sir, listen, costs that are incurred to find manufactured product which does not meet the specifications are called as, to find, not rectify, just you are finding out, so it's nothing but appraisal cost. So C has to be the answer. Next, cost incurred for defective products before the shipment to customer can be categorized as, so cost incurred for defective products before the shipment occurs to the customer. So there it's not so clear that whether it is finding out rectification. Cost incurred to defective products is nothing but they're missing, so you can consider it as if it is an appraisal, that is nothing but finding is defective. Next, cost incurred for defective products after the shipment to the customer is classified as, cost incurred for defective products after the shipment to the customers. So that has to be after the shipment to the customer, that has to be this one, sir. Has to be external failure, not internal failure. Not this has to be the answer. Next, cost of rework is a cost related to, so internal failure. Rework cost, we are doing a rework of the damaged product internally before reaching the customers is related to internal failure. What next? Cost incurred to ensure that the failure does not happen. Failure does not happen. Understood? You are making sure that there is no failure in future. That has to be a prevention cost. Next, costs that are incurred to prevent low quality cost production is classified as cost of quality anyhow. Next, what is the 4 P's in total quality management? The total quality is management in the sense all the resources, all the people in an organization comes combinedly, follow the same process, identify the problem and rectify those things. So total quality management has to be all the people has to be combined, sir. It's not a principle or it's not a product. Every people in an organization has to work under total quality management. So people is the major criteria. So that should be an answer. Next, which of the following is not quality parameter for service organization? So for service organization, which is not, consistency has to be, friendliness has to be, promptness has to be, but durability no. Durability is for manufacturing sector. For service sectors, they won't look for durability, sir, because service is nothing but one time service. It is going to be completed anyhow, your service, but your service has to be consistent and it has to be in friendly nature as well as promptness on time. But durability no, for manufacturing sectors only that has to be there. Next, there are 3 core areas to consider when developing a supply chain strategies on the business cases are, first thing, people, core people, process and systems. That has to be the core things. Yeah, that's the basic definition, sir. Now, warranty period return in the sense it has to be external failure returned by the customer, so it has to be the external failure. Now, downtime due to defective in quality is an example of internal failure. So internal failure only, it has to be downtime due to. And which of the following quality cost incurred in the process of uncovering defects? So just uncovering the defects are nothing but finding, okay, this is the defect they are uncovering, okay, this is the defect they are saying. So it has to be appraisal, not rectification. They are just identifying this is the defect. Next, which of the following quality cost is incurred when inferior products are delivered to the customer? That is, after delivery, then it has to be external failure cost. So okay, sir, this is not a delivered circuit. It's correct only, internal failure only. This is shipment is done, not delivered yet, so it has to be internal failure cost. So shipment is done, before delivering to the customer, we are going to check whether the quality is good or not, and if it is good, we deliver it. If it is not good, we bring back and do the rectification, and again we are going to give. So it has to be internal failure. That is correct only. Okay, so that's about cost of quality. Then Six Sigma and Pareto. Yes. The price stands for, so the price is nothing but to rectify the rectification of the damaged thing. What should be the process we should find out? So there are many things has to be rectified. Out of that, first identify the problem. After identifying the problem, which is the major problem we are having, give the rankings based on that. The major problem in the sense which impacts customer more, which one has to be rectified faster so that customers will get satisfied. Understood, right? So we have to rank them, analyze them, and then rectify them by innovating some ways to rectify it. So your answer has to be C. That was the price which is under Six Sigma. Next, Six Sigma about quality systems. It's not about the control. You have to manufacture the quality product. So it's the quality systems. Next, DMI ADV is a methodology associated with Six Sigma. Obviously, there are 2 methods for us, which is DMI ADV, where new product, if we are innovating, before a new product itself, we have to ensure that we have to manufacture a quality product by taking the past experience. That is the reason why. So that concept is given under Six Sigma. So Six Sigma has to be our answer. So as the following, so this one you have to understand these names of the people who is telling what. That you have to memorize that one, definitely. So okay, that we have to memorize that one. C has to be the answer. Just memorize the name of the person, what he is saying. Next, Pareto analysis recognizes 80:20 rule. So what normally Pareto analysis says that 80% of the problems arises in an organization due to 20% of the inputs, 20% factors. Out of all the factors, 80% of the problems will be arise due to 20% of the factors. So that's what 80 is to 20 rule. What it right? So mostly like not every factor will impact every time. Every time for the organization, there will be some factors which normally faces some more issues to the factor. Normally they says that lowest 20% factors will affect 80% of the times. Okay. So that's about Six Sigma and Pareto. Let's take 10 minutes break and then we can start with marginal costing.
Okay, so next let us see marginal costing, or else let us see, let's complete small topics first. Tomorrow we can see this marginal costing big topics. Transfer pricing. Division A of a company manufactures a single product and the following data are provided. Okay. Head office assess divisional performance by the method of RI and uses cost of capital of 12%. Then what should be the transfer price, sir? They're talking about transfer price. Okay. Now they says that divisional performance is based on residual income, they are saying. Now, sir, what is residual income? RI is equal to EBIT minus capital employed into cost of capital. That has to be the RI. But the divisional performance is based on RI, they are saying, and capital employed is given as 10 lakhs. Net assets is nothing but capital employed, and RI is nothing but 3 lakhs. And based on that, let's find out how much is the profit we are supposed to get. That implies 3 lakhs is equal to EBIT minus capital employed is 10 lakhs, WAC is 12%. Then 10 lakhs into 12% is 1,20,000 plus 3 lakhs, 4,20,000. Then EBIT is nothing but profit, sir. Under costing, EBIT is nothing but profit. So that implies profit should be equal to 4,20,000. Clear? Then what should be the contribution, sir? So they says that fixed cost is 4 lakhs plus 2 lakhs, which is equal to 6 lakhs. Depreciation is also fixed cost. Now contribution should be equal to fixed cost plus profit, which is equal to 6 lakhs plus 4,20,000, which is equal to 10,20,000. How many units, sir? 25,000 units. Yeah. So it has to be 10,20,000 divided by 25,000 units. It's 40.8. 1 second. Residual income is 3 lakhs. EBIT. Capital employed is 1,20,000. 4,20,000. Contribution has to be fixed cost plus profit. Where it is 10,20,000. Oh, so some information is missing, sir, here. Okay, so that was the printing mistake, sir. Residual income is not 3 lakh 30,000, sir. If residual income is 30,000, then the profit has to be 1,50,000 and contribution has to be fixed cost, and also the question also saying us to take contribution per unit, sir. They're asking us contribution per unit only by taking this. That's the printing mistake. They're asking us contribution per unit. So while copying the question, it was some data is missing. So now fixed cost is 6 lakhs plus profit is 1,20,000, where the total contribution is 7,20,000. Then this has to be the answer, 7,20,000 divided by 25,000. Got it? So 7,20,000 divided by 25,000. So even that it is giving us the profit is 150, sir. Sorry, 7,50,000. Yeah, then it has to be 30. Clear? Okay. Next, a company makes components and sells internally to its subsidiaries and also to the external market. Okay, the external market price is 24 per component. So to the external market the price is 24, sir, which gives us a contribution of 40% sales. And what has to be the variable cost, sir? Variable cost is equal to 24 into 60%, which is equal to 14.4. Okay, for external sales, a variable cost of 1.5 per unit on for distribution cost. This is, however, not incurred for internal sales, sir, and this is variable cost for external sales. Then for variable cost is equal to 14.4 minus 1.5. This is for internal sales, and there is no capacity constraints. It means that we can manufacture additional units for internal purpose, and there is no, as there is no capacity constraints, the additional, if you manufacture the additional unit, that has to be variable cost per unit only you are going to incur. Fixed cost you are not going to incur, so that the transfer price is fixed based on variable cost only. So for what is in variable cost for internal factor? So 1.5, which is 12.9. So 12.9 has to be the answer. Whenever there is no capacity constraints, you are not going to incur any additional cost for manufacture, any additional fixed cost for manufacturing additional unit. You are going to incur only variable cost. And in the variable cost of external sales, there are having 1.5 rupees of distribution cost, which is not incurred for internal transfer. So after deducting that, the variable cost of manufacturing for us is 12.9. So B has to be the answer. Next, a company makes components and sells internally to its subsidiary and also to the external market. Okay, the external market price is 24, which gives the contribution of 40, external sales 3 per unit, which is towards distribution. Okay, same question, sir, but in the place of 1.5 we are getting 3. So our answer has to be 14.4 minus 3. 14.4 minus 3, 11.4. 11.4. Next, which of the following is not a method of transfer pricing? Cost plus transfer is there. Internal price. So internal price, transfer price, there is nothing such method is there. So this has to be market based pricing is there. Two-part pricing is also there. Dual pricing we call it as. So while transfer pricing we already seen it, it is a dual pricing is there. Two-part transfer price is also available, but internal price transfer is not there. Next, H groups has two divisions, division P and division Q. Division P manufactures an item that is transferred to division Q. Okay, now they are saying that P is transferring to Q.
Okay. An item has external market price of no external market. So there is no external market. They have to transfer internally only, and 600 units are transferred. So 6,000 units were transferred internally each year. The cost of divisions are as follows. For division P, variable cost is 100 and fixed cost is 1,20,000, and if it is per unit divided by 6,000, which is 20 rupees. Okay. Head office management decided that the transfer price should be sent that provides profit of 30,000 to the division. So what should be the profit, sir? Profit per unit is equal to 30,000 by 6,000, which is equal to 5. What should be the transfer price? Then TP has to be equal to 100 plus 20 plus 5, which is 125. Clear? Okay. Next. Max Limited fixes the internal divisional transfer price for its products on the basis of cost plus ROI. So they wanted to make cost plus ROI. The budget for division X for 2019-20 appears as under. Fixed assets is given, current assets is given, debtors is given. This is nothing but total capital employed. The total capital employed is nothing but, sir, in a balance sheet, these are source of funds and these are applications of funds. These two are always equal. What it total assets are nothing but total capital employed. The only difference is variable cost is not to be taken. So at the beginning of the period, we raise company for two things. Whenever we start a company or whenever we start a business, we raise capital for two things, sir. One is fixed assets, the other one is working capital, sir. This should be the total capital employed. So total it is 10 lakhs. Okay. Annual fixed cost is 8 lakhs. Variable cost of a product is 10. Budgeted volume is 4. Desired ROI is 28 lakhs. So what is ROI per unit, which is 4 lakhs into, or not 10 lakhs, sir, into 28% divided by 4 lakhs, which is equal to 2,80,000 0.7, and transfer price is equal to, the variable cost is 10, fixed cost is 8 lakh by 4 lakh, which is nothing but 2, and ROI is 0.7, which is totally 12.7. So A has to be the answer. Next. If the opportunity cost per barrel was 45 per unit, incremental cost per barrel is 65, then what should be the minimum transfer price? Obviously, to manufacture that, they are going to incur 65 rupees and they are going to miss 45 rupees because of manufacturing this one. So both has to be covered, which is 110. Then method of pricing, when two separate pricing methods were used to price transfer of products from one subunit to the another, is called as dual pricing, sir. There itself you can find out two separate pricing methods whenever we are using, that is called as dual pricing method. Okay. Some of the methods used for determining transfer price are market based transfer prices, cost based transfer prices, negotiated transfer prices. Answer has to be all of the above, not the cost based transfer prices. Clear? Okay. Because we can have market based, we can have cost based, and we can have the negotiation between two divisions. So if there are two divisions, division A and division B, based on the negotiations also we can fix the transfer price when the market prices are not available. So all the four are correct only. Next. A company fixes the interdivisional transfer prices for its products on the basis of cost plus return on investment to the division. Okay. The budgeted capital investment is 10 lakhs. So there it's based on ROI, sir. And capital investment is 10 lakh, fixed cost is 8 lakh, and expected is 4 lakhs, and selling price is 12.4 4, variable cost is 10. What should be ROL, sir? ROL, same question. Same question. They given 12.7 as the transfer price. 12.7 as the transfer price, but they are missing this one. This they are making. So reverse calculation of same. So our answer has to be 28%. Same questions are reverse calculations. So first from 12.7 of total, variable cost deducted and fixed cost is also deducted. Then what is left over? 0.7 is left over. For how many units? That is for 4 lakh units. Total profit is 2,80,000 upon 10 lakhs, which is 28%. Same question, but reverse calculation. They're asking us RO. How much is our? That's not ROL, ROI. How much is our ROI? They are asking. So from the total transfer price, deduct the cost, then find out the profit. So profit per unit is 0.7. 4 lakh units we are selling. 2,80,000 is the total profit, and for the investment of 10 lakhs. So 28% has to be your ROI. Okay. So that's about transfer pricing. Next small topic. Okay. Asset life cycle costing. Let us discuss this. In the calculation of life cycle cost of a product, which of the following items would be incurred? Sir, first of all, let me discuss about what is life cycle costing. So traditionally, if you observe, we calculated cost from direct material consumed. So whenever you are preparing a cost sheet, we start assuming cost from materials, sir. But think practically, we are going to incur cost not just from material, even from planning a product. To plan the product, to do some R&D or market research, whether to start this product or not, from there itself, we are going to incur some cost. And samples we manufacture, and we are going to test it, whether it is according to our estimations or not. And all such costs we are going to incur for a product, not just from starting off after deciding yes we can start the product. Yes, we can start the product. From there only traditional costing starts, sir. Where from purchase of raw materials, raw material consumed, direct labor, from that. But life cycle costing takes every cost from planning stage to extinction stage. Planning stage to extinction. That's nothing but exiting the market. Every cost incurred for the product will be considered under life cycle costing. Okay, now in calculation of life cycle cost of a product, which of the following items would be included? Planning cost, obviously. Preliminary and detailed design cost, yes. Testing cost, yes. Production cost, yes. Distribution cost, yes. Every cost has to be taken. All of the above. Now, life cycle cost consider cradle. Understood, right? The child where we keep in a cradle, right? From that to grave. So it means not from birth to death. Every cost will be included. So cradle to graveyard. Next. Span time from initial research and development of a product till support and customer service, if not offered for the product, is particularly called as product life cycle costing, sir. Span time of initial research and development of a product. If it is of an asset, that is asset life cycle costing. If it is of a product, it is life cycle costing. Sorry, product life cycle costing. So it has to be product. They given a product, sir. So from product, from initial research to end, to the end, whatever the cost it is incurred, it is called as product life cycle costing. If it is an asset life cycle costing. Okay. During which phase of product life cycle costing sales arises at increasing rate? Sir, under product life cycle costing, what we do is whenever we introduce the product. When we are introducing the product, our sales are very less. We are just about to capture the market by giving offers and all. There won't be any growth. But in growth stage only, we start getting sales and we start getting profits also. So it has to be growth stage. So that's about life cycle costing. Okay, then topics.
Okay, so till now we completed with introduction to SCM as well as quality cost management, transfer pricing, product life cycle costing, so for asset life cycle costing they have not given any MCQs in your study material or past examinations also, so we have not given that, as well as be done with standard costing. These things we have given, and uniform costing is removed from your new syllabus, sir. I think they won't ask you any questions from uniform costing, that we can leave it. Clear? Okay. Then now let us start with marginal costing. To some extent we will complete today, and remaining questions we can see tomorrow, because it's a bit lengthy one, so some questions we can see it. Then from now we can go in a sequence. Or Six Sigma and Pareto is also completed. Then marginal costing. See here. Marginal costing is very important. Listen very carefully. Minimum 2 MCQs you are going to get it from marginal costing, and in previous attempt they have given 5, sir. 5 MCQs alone from marginal costing they given in previous attempt, so be careful with that. Okay, listen here. A company produces a product which is sold at a price of 160 and variable cost is 64. Then what has to be contribution, sir? Better you find out contribution ratio, which is 160 minus 64 divided by 160, which is 96 divided by 160, 60%. Because PV ratio is the very essence one. That is the reason why I have not even seen what question they are asking, but PV ratio definitely it is most of the cases it is necessary for us, sir. Now company's fixed cost is 23,04,000 per annum, and company operates margin of safety at 40%. So listen, out of total sales there will be break-even sales. On and above the break-even sales all are called as margin of safety. If this is 40%, break-even sales has to be 60%, sir. Okay, they are asking about the total sales. So for 60% sales, these break-even sales covers fixed cost. Clear? So listen very properly. What are the sales which is covering fixed cost? That's nothing but break-even point sales into 60% PV ratio is equal to 23,04,000. Then what about break-even point sales, sir? Break-even point sales is equal divided by 60%, which is 23,04,000 divided by 60%, which is 3,84,000. And this is nothing but 60% of the sales. Then what about total again divided by 60%, 64 lakhs. So your total sales has to be your total sales has to be 64 lakhs, but they're asking in units. Selling price per unit is 160, so divided by 160, which is 40,000. So 40,000 has to be the answer. Next, the PV ratio of a firm dealing in electronical equipment is 50%. Okay, PV ratio is given as 50 and margin of safety is given as 40. Break-even point of the sales volume. They are asking about the break-even, sir. If margin of safety is 40, 60% has to be break-even sales. So 5 lakhs into 60%, which is for 50 lakhs into 60%, which is nothing but 30 lakhs. Very straightforward question it is. We never bother about PV ratio also, because if margin of safety is 40%, obviously your break-even sales has to be 60% of total sales. Okay, next. Hilton Hotel has a capacity of 100 single rooms and 20 double rooms. Average occupancy is 70% for 365 days a year. Okay. The rent of a double room is 150% of a single room. Then the total room capacity days, not capacity, occupancy days
In the year, in the terms of single rooms, they are saying, sir, in the terms of single room, how much is the occupancy? Now, one double room is nothing but 1.5 single room. Clear? Then how many single rooms? Number of single rooms is equal to 100 plus, in terms of single room they are asking, so 100 plus 20 into 1.5, which is equal to, so 130 rooms, sir. Out of this 130, 75% is the occupancy, so 130 into 75%, which is 97.5 into 365, so 35,000. 1 second. The rent of a double room is kept as 1.5. 150% is one double room is equal to 1.5 single room. Correct only. How many double rooms are there? 20 double rooms are there. So it has to be 20 into 1.5, 30 plus 100. So 130 is there. So how many? 130 into 365. 47,450. Out of that, occupancy is not 70%, sir, not 75. Sorry. If it is 70 into 70%, then we are getting 33,215. Correct. 70% into 365, sir, per day. So then we are going to get 33,215. D is correct. Sir, understood this room, right? This one in service costing already we have seen it. Listen very carefully. What they are saying is that the total room capacity in terms of single room, and they said that our average occupancy is 70%. So how many single rooms are equivalent single rooms are there? Equivalent is nothing but one double room is equal to 1.5 single room, because 150%, right? So number of single rooms are nothing but 100 plus 20 into 1.5, total 130 is there, and our occupancy is 70% per day. So they're asking in a year. So into 365, then we are going to get 33,215. Okay, next. By making and selling 9,000 units of a product, company makes a profit of 10,000, whereas in case of 7,000, sorry, if you see here, when you sell 9,000 units, you are getting a profit of 10,000 rupees, and when you sell 7,000 units, you are getting a loss of 10,000 rupees. So you have to get a break even, sir. But if you remember very carefully, fixed cost never impacts your break even. Understood, right? I mean to say, your profit fixed cost is not the reason why there is a change in profit. Change in contribution is always equal to change in profit. Clear? Fixed cost is always constant. Sir, from here to here, there is a difference of 2,000 units, sir. For 2,000 units, there is a difference in profit of 0. Net profit is 0. Understood? Exactly at between, we are going to get a break even. Here 10,000 profit, here 10,000 loss. Exactly to get a break even point, it has to be between 9,000 and 7,000. It's a very basic thing we know in marginal costing. Contribution changes proportionately. For 2,000, if there is a change of 20,000 rupee, so total change is 20,000 rupee here, because 10,000 loss, 10,000 profit, both. Then definitely it will be, your break even point will be 9,000 plus 7,000 by 2, which is nothing but 8,000. Your answer has to be 8,000. But if you are not aware of this logic, let us assume that if you are not aware of this logic, then how to solve this problem? Regular formulas. With regular formulas, how to solve it? What is that? 9,000 into contribution per unit minus fixed cost is equal to 10,000. 7,000 into contribution per unit minus fixed cost is equal to minus 10,000. Minus 10,000. Now, if we add these two, then 16,000 contribution is equal to 20,000. Then contribution is equal to, yeah, 20,000 by 16,000.
1.25. 1.25. Now, how many units of contribution has to make a fixed cost? Now I have to find out a fixed cost, sir. Apply anywhere. Apply this 1.5 anywhere. That implies a fixed cost is equal to 9,000 C minus 10,000, which is equal to 9,000 into 1.25, 11,250 minus 10,000, which is 1,250. Sir, how many units has to make? 20,000 divided by 16,000. Yeah, 1.25 correct only. So how many units are making? How many units contribution is required to get a fixed cost of 1.25? That's what's the break even point is equal to 1250 divided by 1.25. 1250 divided by 1.25 is 1000. I think somewhere calculation mistake is there. Contribution of 9,000 units minus fixed cost makes a 10,000 profit, correct? Whereas 7,000 units contribution minus fixed cost would make a loss of 10,000, correct? If we add all this, somewhere minus 2f. Second. Okay, sorry sir, calculation mistake it is. If you minus that, if you do minus, then minus will become plus, minus will become plus, and it has to be 2,000 C is equal to, sir, sorry, 20,000. Then C is equal to 10, sir. Contribution is equal to 10. Then your fixed cost F is equal to 9,000 into 10 minus 10,000, which is equal to 90,000 minus 10,000, 80,000, sir. Then break even point is equal to fixed cost divided by contribution per unit, which leads you 8,000 units. Yeah, got it right, 8,000 units. But no need to do such calculations, sir, because it's an MCQ, right? We know that anyhow it changes proportionately. So this side 10,000 profit, this side 10,000 loss. As changes proportionately, between value also will be just exactly middle of the units, which is nothing but 8,000 units. In seconds we can complete this MCQ, sir. By solving all these things it may take some time, but if you know how these variable cost and contribution behaves properly, then definitely this MCQ can be solved in seconds. What it right? This side 10,000 and this side 10,000, so that to get a break even point between middle value we should require for, so 8,000 plus, sorry, 7,000 plus 9,000 divided by 2. That should be our answer, sir. Okay, next one. Ginger Limited makes leather purses. It has drawn up the following budget for the next financial period. Okay, selling price per unit is 11.6. Variable cost is 3.4. Then PV ratio is equal to 11.6 minus 3.4, which is 8.2 divided by 11.6. Okay, yes. Sales commission is 5% of the sales. This is also variable only, sir. Sales commission is given, that is 11.6 into 5%, which is 5.08. Variable cost is equal to 3.4 plus 11.6 into 5%. First let's read full question, sir. Then fixed production cost is fixed cost is given as 4 lakh 30, fixed selling expenses and administration is 1 lakh 90. Total fixed cost should be equal to 4 lakh 30,500 plus 1 lakh 98,150, which will gives you 6 lakhs 28,550, and total variable cost is 11.6 into 5 percentage plus 3.4, which is 3.98. Then sales is 90,000 units, and what is margin of safety represents it. So let's find out break even sales, then you are going to get anyhow margin of sales. What has to be the margin of sales? Contribution per unit is equal to 11.6 minus 3.98, which is minus 11.6, which is 7.62. Clear? Then how many units? Break even units. Break even point units is equal to 6 lakhs 28,500 divided by 6 lakhs 28,500 divided by 7.62, which is 82,480.31 units. Then minus 90,000, that has to be break. Then MOS is equal to 7,519.69 units out of 90,000 units. So divided, percentage is given right in option, so divided by 90,000 into 100, it is 8.3552 percentage, which is nothing but 8.3 percentage. Clear? They're just asking us how much is the MOS sales. So MOS sales are nothing but on and above the break even sales. Fixed cost is given, then we can find out break even point by dividing by contribution per unit, then we are going to get break even sales. Out of total sales, if you deduct the break even sales, we are going to get MOS sales. As they are giving percentage divided by total sales, we are going to get 8.3552. That's nothing but 8.3% has to be the answer. Next, a company uses standard absorption costing to value inventory. Okay, its fixed overhead absorption rate is 12 per hour. Fixed overhead absorption rate is 12 per hour. Okay, and each unit of the production takes 4 labor hours. Each unit of production should take, that's nothing but standard, sir. Should take in the sense standard. Okay, then what has to be budgeted overhead rate per unit? Per unit it is nothing but 12 into 4, which is 48. Okay, in the recent period there was no opening inventory of finished goods, but 20,000 units were produced using 1 lakh labor hours and 18,000 units were sold. Okay, 20,000 units are produced, sir. Then what is absorbed overhead? Absorbed overhead is always for actual output, which is 20,000 into 48, which is equal to 20,000 into 48, which is equal to 9,60,000. Okay, and the actual profit was 4,64,000. What profit would have been earned under standard marginal costing system? And they says that absorbed amount is 9,60,000. Then what is an actual overhead processed using 1 lakh labor hours, and the actual profit was okay. And what is actual overhead? Actual overhead has to be the actual output of 20,000 units. Some information, 1 second. The profit has been standard marginal costing system. Acha, okay. 20,000 units, 4 labor hours per unit, 20,000 into 4 labor hours per unit, which leads to 80,000 into 12, which leads 9,60,000. That's okay. Okay, sir. Just a simple logic we are missing. We don't require all such calculation also, sir. The one thing which we missed is, sir, that is fixed overhead absorption rate. In marginal costing system, closing stock will not have, in marginal costing system, closing stock will not have fixed overhead absorption. Only variable cost is carried. Variable cost is carried. So what is closing stock, sir? 2000 units, and each unit is 48 rupee. Got it right? Absorption rate is, standard rate is 12 into 4. Standard rate per unit is equal to 12 into 4, which is 48, sir. What is 2000 into 48? 2000 into 48 is equal to 96,000, sir. 96,000, sir. But in absorption costing, they're going to calculate, they're going to carry forward the fixed cost also. They're going to carry forward the fixed cost also. But in marginal costing, total fixed cost is absorbed in the same period. It means marginal costing profit will be 96,000 rupees lower than the actual profit. Sir, in actual profit, fixed cost is also carried to next year. But in marginal costing, total fixed cost has to cover in the same period. As we are covering more fixed cost, our profit will be 96,000 lower than the actual. Therefore, marginal profit is equal to 4,64,000. 4,64,000 minus 96,000. Minus 96,000, which leads to 3,68,000. Simple, sir. The main difference between absorption costing and marginal costing is that in marginal costing, we are going to cover all the fixed costs in the same year. So 96,000 fixed cost we are covering in the same year. But in actual, what they did in closing stock, and this is not closing stock, this is fixed cost in closing stock. Fixed cost in closing stock is 96,000, sir. The same 96,000 will be absorbed in the same period under marginal costing. So as I am covering more cost, my profit will be lower. How much lower? 96,000 rupees, my profit will be lower. So 4,64,000 minus 96,000, which ends up with 3,68,000. Same simple logic we are using. Okay, next. A company determines its selling price by making up a variable cost as 60%. Okay. In addition, the company uses frequent selling price markdown to stimulate the sales. Okay, they wanted to decrease that one. If the markdown average is 10%, what is the company's contribution margin ratio? Sir, listen. Earlier, if the sales is 100, variable cost is 60, so that our contribution has to be 40 earlier. But now they wanted to mark down our sales by 10%, which is 90, but still my variable cost will not change, sir. If I decrease my selling price to improve my sale units, why do you think that we can get at lower cost? Labor we may not agree to pay less amount, or materials also may not get at lower cost. Variable cost will not change. And what will be our revised contribution? 30 upon 90. So 30 divided by 90, which is 33.33%. We can go for, the company determines its selling price by making up variable cost 60%. Okay. In addition, the company uses frequent selling price markdown to stimulate sales. If the markdown average 10%,
What is the company's contribution margin ratio? If sales is 100, variable cost is 60, contribution has to be 40. Now they're decreasing by 10%. If the markdown average is 10%, okay, what will be the contribution margin ratio? Contribution margin ratio, it has to be none of this. 33.33 has to be. That has to be 33.33 only, sir. There is no way it is 30.6. Your answer has to be none of this. Okay. Next. Ani Limited has earned a net profit of 1 lakh, and its overall PV ratio and margin of safety were 25% and 50% respectively. What is the total fixed cost of a company? Sir, profit is 1 lakh. So 1 lakh divided by PV ratio has to be profit, because here has to be margin of safety sales, because MOS is equal to profit by PV ratio. That is nothing but 1 lakh divided by, and PV ratio is 25%. 1 lakh divided by 25%, which ends up with 4 lakh. Got it right? Then if margin of safety sales is 50%, break-even sales also has to be 50%, because break-even point sales also has to be same 4 lakhs into, they're asking us total fixed cost of a company, which is 25%, because your margin of safety is 25%, which is nothing but 1 lakh. And again, sir, to solve this sum, there should be a basic logic that as MOS sales are 50%, break-even sales are also 50%. As exactly 50% is there, our profit and fixed cost has to be equal. So if profit is 1 lakh, our fixed cost also has to be 1 lakh. So we don't need to solve all these things, sir. A simple logic that as MOS is 50%, sir, what is MOS sales means? The sales which gives us profit is called as MOS sales. What is break-even sales? The sales which covers fixed cost is called as break-even sales. So if both are equal, if both MOS sales and break-even sales are equal, the contribution on those sales also has to be equal, obviously. So it means contribution on MOS is 1 lakh, then contribution on break-even also has to be 1 lakh only. Got it right? The same logic can apply, and without solving anything also we can say answer is 1 lakh, because they are given as 50% here. Okay, next. Sir, which of the following would take place if the company is able to reduce its variable cost? Which of the following would take place if the company is able to reduce its variable cost? If the company has to reduce its reduces variable cost, what happens to margin of safety? Obviously, if variable cost is decreasing, contribution is increasing, so that we can cover fixed cost fastly, so that break-even point decreases. And if break-even point decreases, obviously margin of safety increases, because margin of safety is nothing but total sales minus break-even sales. So if break-even sales is decreasing, margin of sales has to increase. So C has to be the answer. Clear? Now see 10th one, sir. Marriott Hotel has a capacity of 100 single rooms and 20 double rooms. Average occupancy is 70%, 70% of 365 days. The rent of double room is kept as 130% of single room. The total rooms is, okay, the same thing, right? One double room is equal to, already we solved it, right? One double room is equal to 1.3 single room. Now
what is the total room occupancy in terms of single room they are asking? Then how many rooms are available for us? Total single rooms is equal to 100 plus 20 into 1.3. 20 into 1.3, which is 26. So 126 rooms, and the occupancy is 70%. So into 70% into 365. What it? So 126 into 70%, 88.2 into 365, which is 32,193. 32,193. Okay, next. Company produces a product which is sold at a price of 80. Variable cost is 32. The company's fixed cost is 11,52,000 per annum. The company operates at a margin of safety of 40%. What is the total sales, sir? So if margin of safety sales is 40%, break-even sales has to be 60%. And 60% sales covers 11,52,000 because break-even sales covers fixed cost, sir. Got it right? Now, 11,52,000 divided by PV ratio. First, let's find out PV ratio. Or as they given in units, let's complete in units only. So, what is break-even point units? 11,52,000 divided by 80 minus 32, which is equal to 11,52,000 divided by 48, 24,000. Sir, and these 24,000 leads to 60% sales, sir. Then total sales has to be 24,000 divided by 60%. Divided by 60%, which is 40,000. So 40,000 has to be your answer. Next. Which of the following is not a quality parameter of service organization? So which is nothing but durability, which is already seen earlier. Now, which of the following would decrease unit contribution margin? So which of the following decreases unit contribution? They are saying 15% decrease in selling price. Obviously, if selling price decreases, where contribution margin also decreases. So A should be the answer. If variable cost increases, which of the following would decrease unit contribution margin? The most they are saying. The most they are saying. Let us solve that one. Sir, if there is 100 rupees of selling price, let us assume 60% is the variable cost and contribution is 40 as of now. If selling price is decreasing by 15%, then it is 85, 60, then 25 divided by 85. Your new ratio will be 29.49. 29.41%. Earlier it was 40%. Decrease unit contribution at the most they are saying. Next, if variable cost is decreases by, obviously variable cost increases, these two are eliminated anyhow because variable cost decreases, contribution increases only, and 50% decrease in fixed cost never impacts your contribution itself. So just check with these two. So 100, and if it is 60 minus 15%, 51. So 100 minus 15, 49. 49. So it has to be 49%. What it right? Which would decrease most? Yes, obviously this decreasing the most. This decreasing the most. So obviously, or it is increased, right? 60 plus 15%, 69. 100 minus 69, which gives you 31, sir. So 31%. You see, this decreases the more. Here it is 31%, and here is 29.41%. So this is decreasing by the most. So A has to be your answer. Then next. Yeah. Okay, sir. Remaining things we can see tomorrow. We can stop up to this today. Thank you.